Okay, so welcome back to the second part today. I told you just about the difference between the first and second best solution being basically the cost of financial intermediation. And again, asymmetric information plays a large role and will play a large role in the next couple of minutes. And financial contracts. Again, what are the basic characteristics of financial contracts? First, we have to see that service and compensation in any financial contract usually do not take place at the same time. So we will give out the loan at one point, but loan repayment and dividends, interest payments will be paid out later, back. And we want to design financial contract, and the financial contract design means that it doesn't stay just with capital lending, giving capital from A to B, but including some additional clauses in the contract to make sure that everyone sticks to what has been agreed upon. So under certainty and symmetric information, we would get the internal rate of return as the fair price of the financial contract. Under uncertainty and symmetric information, we would need to include the individual risk tolerance or risk preference. For example, if you are risk neutral, risk averse, and then include it in the interest rate to formulate a contract. You might know this from asset pricing and risk neutral pricing, that if it's just under information symmetry and with certainty, the internal rate of return is the fair price of capital. Under uncertainty and symmetric information, it is slightly different. You need a risk-adjusted rate of return. And for both cases, if you have asymmetric information, you need to include something more. What? You need to make sure that both sides stick to the contract. We call this, the contract is incentive compatible. Anreizkompatibel in German. What does it mean? It means that both sides have an intrinsic or extrinsic incentive to reveal information or to stick to the behavior that has been agreed upon in the contract. That's what incentive compatible is. And this is what we'll do next. So let's turn to some of these explanatory approaches. We'll start with a risk-averse lender. The lender is noted as L. It can increase utility by increasing the number of projects he or she is investing in, so he can risk diversify. So we are a lender. Might be too costly to invest in a large number of projects because each financial contract is associated with some costs, transaction costs, so it might be easier to use a financial intermediary, the FI, the financial institution, or a bank in this case. And the financial intermediary can lower transaction costs. How? By decreasing the number of transactions. As a lender, I will give my money to one financial intermediation. I no longer have to look for all those different investment projects. On the other hand, the bank can do it on a larger scale. Second, we can lower the cost of each transaction through standardization of financial contracts. And if you think of a bank, of a real example of a bank, this is what usually happens. I mean, all accounts, all loans are standardized at a bank, and you can reduce transaction costs by standardization only. And then you will profit from economies of scale in economics. That is, if financial contracts have fixed costs, transaction costs increase less than proportionally to the financing volume. So we can lower transaction costs without reducing diversification. A very naive way of thinking how a financial intermediary can give us a benefit. It only acts as an intermediary that by engaging in wholesale business and standardization can reduce transaction costs. Could be but this is the neoclassical explanation. Could be that the financial intermediary is a service provider. So the bank provides information, for example, via credit rating and credit risk assessment or project evaluation and product monitoring. Could also be other services. Could also be that they offer risky long-term loans and so on. The idea is that the financial intermediary, for example, is better able to screen those investment projects. Could be we bring our money to a bank on our savings and checkings account. The bank gives out a mortgage loan, and the bank, or a business loan, even better, and with the business loan, the bank is specialized on monitoring how these customers perform. And if they see that a business customer who has a loan with the bank performs badly, they can maybe increase interest rate, or they can try to get early repayment. Let's rather stick to information economics. Information asymmetries could discourage both parties from entering such a contract, because in the end, interest rate may be too high or risk may be too high, and one of the parties, usually the bank or the investor, the lender, will say, okay, I don't want to do this contract. The risk is too high. Now, the financial intermediary could exist because it is able to reduce information asymmetries. In a sense, I, as a lender, I'm suddenly able to better see the risk of a customer, of an industrial company that wants to invest. So the bank evaluates and monitors projects, and it formulates incentive-compatible contracts. We have lenders, L, we have entrepreneurs, firms, E, lenders, L, and we have an information asymmetry about the success of the business project returns. Let's make it a very simple example. I'm a lender, I want to invest, and let's say you are an entrepreneur, you want to buy a machine and invest money. First thing is, I could give you the money directly. I have search costs, I have transaction costs, etc. But let's assume now transaction costs have been dealt with, but I still have information asymmetry. Why? You know what machine you want to buy, how it will perform, and how your return will be. I can only trust you that you will give me that information. I am not willing to stand right next to you in your company and monitor what machine you are buying. So we have information asymmetry between the lender and the entrepreneur. What happens now is we introduce a financial intermediary, and the financial intermediary gathers information about all potential entrepreneurs, and it provides this information to all lenders for a certain fee. Now we include a financial intermediary. Let's assume the gentleman in the first row is a financial intermediary now, and you charge a fee for gathering information and giving it to lenders about all possible entrepreneurs. That's okay. So existence could be beneficial for everyone, because first of all, if I have no information on the machine, on the entrepreneur's business, I would not give you the capital. So you will profit from this because you get a loan, you can invest. I profit from this because in this scenario I can invest my capital and I will get an interest rate. I will get a return on that. So, and the financial intermediary will profit from this because it has some information costs, it needs to gather information, but it can amortize the costs of acquiring the information across all lenders and across all entrepreneurs. It can specialize in gathering information. Each L reduces his monitoring cost by buying the information at a cheaper price. And because the bank does this for everyone, we have economies of scale, and this will be cheaper than me monitoring each entrepreneur myself. So everyone's better off. Entrepreneur is able to acquire the necessary funds. Lender, it's cheaper for the lender. And we have a financial intermediary who can earn a buck. Problem is, it doesn't solve the information asymmetry. It only moves it away from lender entrepreneur to lender financial intermediary. Why should I trust the bank? The bank could do the following. The bank could simply say, here is some information about the entrepreneur, and I, as a lender, I still cannot check the validity of that information. I could be scammed by the bank. The financial intermediary could simply make fake reports, sell them at a fee, and I would still be in the same situation that I now have information asymmetry between the lenders and the bank. So I, as a lender, can neither rely on information given by the bank or the entrepreneur. Doesn't help. Monetary activity is not sufficient to explain the existence of financial intermediaries, because still we have this problem that we are not solving the information asymmetry problem. So what else can we do to alleviate this, to justify the existence of financial intermediaries? Well, this brings us to the Diamond model. Diamond, as in Douglas Diamond, professor of economics at the University of Chicago, he's famous for, among others, two things: the Diamond model and the Diamond and Dybvig model. The Diamond-Dybvig model is an extension of this setting, where not the existence of financial intermediaries is explained, but the usefulness of deposit insurance schemes. So if you ever hear Diamond-Dybvig, you should know it's deposit insurance, Einlagensicherungssysteme in German. We have an entrepreneur E with an investment project with uncertain outcomes. So it's uncertainty, could go well, could go wrong, could go badly. The uncertain outcome is Y tilde. Y is stochastic, as indicated by the tilde. We have an investment volume of one monetary unit, so it's €1, €1, $1. The entrepreneur has no liquid funds, none whatsoever, so it needs the one monetary unit to invest in this project. It needs to raise capital from multiple lenders, could be one, and we have the assumption and the problem that only the entrepreneur can observe the outcome of the investment project without costs. So we have ex post information asymmetry. We don't know what really happens. What is the only thing we can observe? The amount of money the entrepreneur pays out. So if it pays back the loan in full plus interest, we can assume that the project went well. If the entrepreneur only pays out a fraction or nothing at all, it could be that the entrepreneur has gone bankrupt, but it could also be that he defrauds us as an investor. Without monitoring, the entrepreneur would always report an outcome of 0. If there is no, in this very simple theoretical setting, if there is no legal punishment, if there is no way of monitoring, why should we pay out less? We would always default on our bond. We would always default because it's the best strategy. If the lender cannot observe the real outcome, we will only pay back 0. So what the lender can observe is the actual payment at the end. Without monitoring, it will always be 0. But the lender would anticipate that, and we will thus, we are not stupid. We are not giving any loan if we cannot observe the true outcome and if there's no punishment to the entrepreneur. The result is we know that we will be scammed and we will not give any loans. Solution could be a contract that includes non-monetary punishments that incentivizes the entrepreneur to report the true investment outcome, and we can do project monitoring by the lender. The first one is interesting. What could a non-monetary punishment be? Reputation costs and criminal charges, bankruptcy fraud. If If you never had the intent to pay back a loan, well, this is close to bankruptcy fraud. So if this is included, we might incentivize the entrepreneur to make a correct statement. So it could be imprisonment, reputation risk, loss of manpower in case of insolvency. The punishment without transfer of assets is they should hurt the entrepreneur, but the important thing is they do not benefit the lender. If it would benefit the lender, then the lender would have an incentive to get this type of punishment or profit from this. And this is the difference to monetary punishment, because in that case, it should not go to the lender. So it will only incentivize the entrepreneur to make a correct statement. And we give the entrepreneur ex ante an incentive to meet the required repayment terms, punctually and truthfully. Okay. Why non-monetary punishment? If he does not meet the repayment terms, he doesn't have any assets which could be liquidated. So it has to be non-monetary. Same with criminal charges. If someone goes bankrupt and he or she commits bankruptcy fraud, a monetary punishment will not do any well because he's bankrupt. So he needs to go to prison. Simple argument. Now, this is still without financial intermediary. The optimal financial contract now includes a penalty function. We include a penalty function, non-monetary punishment, that incentivizes the entrepreneur to disclose information truthfully. So, in this model, the non-monetary penalty for the entrepreneur depends only on the repayment amount Z as a function of Y. We can only observe Z. Remember, the lender cannot observe Y and Y tilde. Y tilde is random, and then the actual outcome is Y, but Y is only observable by the entrepreneur. And then the repayment, Z of Y, that's observable. We know what we will be repaid because we see it on our account. So we have a penalty function, phi of Z of Y. And how does the optimal penalty function look like? It should provide an incentive for entrepreneurs to meet the agreed terms of repayment, to pay back what they have. And with a debt, this is, in this context, a debt contract. Remember, deposits are debt, is debt. So this is a debt contract. And what will we pay back? We will pay back H. This is the agreed repayment. And it's the smallest amount E has to pay to the lender to not receive any non-monetary punishment. And the more we pay back, the lower this will be, and the maximum of the two will be the non-monetary punishment. What does it mean? If, say, H is $1,000, we had a loan of $1,000. If we pay back $1,000, then this is 0, and thus phi will be 0. There will be no punishment, non-monetary punishment. If we do not pay back anything, phi will be the maximum of 1,000 and 0. Thus, it will be phi of $1,000. Phi will be non-monetary, but phi will obviously depend on a monetary figure. In this case, the amount of money that is not being repaid. And this is what we refer to, what we consider a normal debt contract. It means that you will have a non-monetary punishment that is proportional to the amount of money you are not repaying to your lender. Directly to your lender without any bank. And this is the optimal contract. So, phi star is the maximum of H minus Z and 0. H is the agreed repayment, smallest amount E has to pay to L to not receive any non-monetary punishment. And let's check whether this debt contract fulfills what we would require from a normal debt contract that incentivizes all participants to stick to the contract. It's incentive compatible because E has no incentive to settle for less than H. So it's compatible with the incentives of the entrepreneur. And phi star is minimal. That is, the non-monetary punishment is always exactly as much as the difference between the agreed payment and the actual payment. So here, if the punishment would be less, then the entrepreneur would not have an incentive to pay back anything. Again, he would simply report 0. Because he would save more than he would lose in non-monetary punishment. So it's minimal in this sense. And it's incentive compatible because it gives entrepreneur the right incentive. Okay. So this is the optimal normal debt contract without financial intermediary. The entrepreneur offers a repayment, which makes L choose the investment project over the risk-free investment, and to maximize the earnings, to make L indifferent between choosing between both alternatives, we see that the expected repayment is our return, that is the risk-free rate, and the repayment, Z, has to be equal to the minimum of H and Y in the aggregate repayment to all lenders. So this is our expected payment. We have a risk-free investment. It offers a return of R on 1 unit. And to be indifferent, our very simple idea, you need to have exactly the return just as your expected return on the risky investment. And the expected risky return is the expectation of Z of Y. And if this is equal to R, then we're indifferent. This is our expected repayment. And again, this also has to hold. Thus, let's think about this. We have the probability that we are getting paid back less than our initial loan. So the probability of Y smaller than H times the expected conditional payment of Y if we're getting paid less, plus the probability that the repayment is actually equal or higher than H times H. And this has to equal R, and this has to equal our expected return and the expected payment. We normalize it to 1 unit, so the repayment is actually 1 plus the expected return. The expected value of that Z thus includes partial repayment with probability P of Y less than H, and the conditional expectation that we get paid out less, and full repayment H with the probability that the return on the project is higher than repayment. And this here, H minus R, is the risk premium. It's what we get back in contrast to the risk-free rate. In case of poor project earnings, the entrepreneur is punished without any benefits for the lender. And because all lenders are risk neutral, they only consider the expected value of the project earnings and not the probability distribution. So just expected return has to equal the return. And repayment is always R. Okay. We talked about comparing the first best to the second best solution to give us an idea of what the information costs are, the costs of information asymmetries. The first best solution under symmetric information is expected outcome, expected payment is simply R. So the entrepreneur's profit is what? For example, if our project pays out 1,800, we have H of 1,000, and we have a return of, say, 1 plus 1, 10%. So in this case here, capital R is 1,100. We are able to pay back the initial loan of 1,000 and the difference of 700. This is our profit. That's the entrepreneur's profit. Because you still have to remember that the entrepreneur is doing this. He or she is investing H to earn a profit that is higher than H, obviously. The second best solution, due to the ex post asymmetry in information, is a debt contract with a penalty function phi star and a suitable H. So the profit is the expected return on the project minus H, and the costs of information asymmetry are now the difference between the first best and the second best solution. And in this case, it's H minus R. Now, penalties reduce welfare. That's clear. If we had information symmetry, we would always choose the first best solution. There's no need to include any penalty function, none whatsoever, because, again, we are taking away something from the entrepreneurs, but the lenders do not get this. This is not a zero-sum game. So we have some welfare loss because we need to force entrepreneurs to do something extra in order for lenders to enter these contracts in the first place. Therefore, it can be advantageous for entrepreneurs to allow all lenders to observe the project earnings. So the second idea is project monitoring. The entrepreneurs must pay the monitoring cost C to every lender. So we have M lenders. So the costs for monitoring are M times C. M lenders, costs of C, and in this setting, in the diamond model without financial intermediaries, the choice of the contract type depends on whether the monitoring costs are higher or lower than the welfare loss and the information costs of a situation where you have a non-monetary penalty function. So to summarize, two possibilities. Every lender has to spend C on monitoring the entrepreneurs, or we force the entrepreneurs to stick to the contract and to disclose the true return and not to default by including a non-monetary punishment, a penalty function. And it could be that monitoring is cheaper, it could be that the debt contract with the optimal penalty function is cheaper. We don't know that. But these are this is the setting without financial intermediation. Now let's turn to financial intermediation. We now include a financial intermediary. Problem is, risky projects and a high requirement of lenders result in high costs in both cases. We either have agency costs in the form of the penalty functions, or it's obvious that it cannot be very efficient for all lenders to monitor all entrepreneurs. So there must be an advantage and economies of scale when the financial intermediary does this for us. So the solution is monitoring costs can be reduced by delegating it to a single third party, which is the financial intermediary, the bank. The financial intermediary can be beneficial for the entrepreneurs and for the lender if it decreases the costs associated with the cooperation problem. And the benchmark is the direct entrepreneur-lender relationship without financial intermediation. We are not comparing it to the first best solution because, let's be clear, if we had information symmetry, we wouldn't need the financial intermediary in the first place. Then we would have a direct relationship between the two. But we have to compare it with the alternative costs without financial intermediation under information asymmetry. And we delegate the problem between the lender and the entrepreneur to the lender and the financial intermediary. So we need to solve this problem now. So how can the new cooperation problem, lender, financial intermediary, be solved? And this is where we have the diamond model with banks as delegated monitors. That's actually how the paper is called, banks as delegated monitors. So this is a schematic of this. We can just skip that. And we have one financial intermediary. He takes over monitoring. So monitoring costs are reduced from M times C to just 1 time, because the bank only needs to do this once for one entrepreneur. Problem is, we now have information asymmetry between the financial intermediary and the lender. So with delegation costs, these are the necessary costs to solve the cooperation problem between the financial intermediary and the lender. To justify now the usefulness of a financial intermediary, we have to show that even though we have delegation costs, in sum, we still get below what we have as agency and information costs in the situation without financial intermediary. So the model assumption is, again, financial intermediary is also risk neutral. It does not own capital. The procedure is, we receive, as a bank, payments from L. We finance the projects of the entrepreneurs. We get repayment from entrepreneurs, and we transfer those payments to lenders. Simple case, bank has deposits, bank gives out loans, and it takes returns on the loans to pay interest on the deposits. What are the total costs of a financial intermediary? Monitoring costs, C, for monitoring the entrepreneur, and the delegations costs, and we will call the delegation cost D. We create information symmetry, and what we do is we have direct investment by the lenders in the entrepreneur's project that is now replaced by investing into deposits of the bank or the financial intermediary. Same success probabilities, share of earnings. We reduce delegation costs by diversifying. So the financial intermediary invests not just in one project of one entrepreneur, but across a huge set of entrepreneurs. We invest funds from M times N lenders into N projects. Every lender agrees on a debt contract with a penalty function, and the total amount of repayment depends on the outcome, the earnings of all projects. So we have risk diversification. Through diversification now, the probability of a negative outcome of the whole project Fi is lower because the project earnings are independent, and the repayment amount H, the lenders are willing to accept, and the welfare loss decreases. And this is basically the result. After diversification, that is, if D gets negligible, we can reduce D to almost 0 because we can diversify across a huge number of entrepreneurs. And the existence of the financial intermediary is justified if and only if the C, the monitoring cost, that we only need to do once, if this is lower than the expected value of phi star of Z of Y. Because this last part is the cost of in reducing information asymmetry in the situation where we have no financial intermediary, and the case of C is the one where we include a financial intermediary. So we have to compare the differences between first best and second best in the scenario where we have no bank and the scenario where we have a bank. And the advantage is we have C, we can reduce monitoring costs, but we also need to reduce the delegation costs. So this is delegated monitoring. We'll come back later to this, but you can see now this is purely theoretical. This is, again, the foundation work of banking theory and, in a sense, financial intermediation and financial economics. But it gives you an idea how you can justify the existence of a bank as a delegated monitor, as a delegated risk manager, and it also explains theoretically why banks exist, and from there on you can extend this in numerous ways. You can include a financial, you can include, say, a deposit insurance scheme. You get to the Diamond and Dybvig model, and you can include more facets of the banking sector. You can now include different types of equity and debt contracts. You can include a continuum of information states. So this model, the basic model, simply argues that you have full information or you have no information. A very simple extension would be to have the amount of information investors have vary between 0 and 1 continuously. Wenn Sie das im stetigen Intervall von 0 bis 1 laufen lassen, dann haben Sie eine Erweiterung dieses Modells, indem Sie eigentlich nur sagen, entweder wissen Sie alles oder Sie wissen gar nichts. Okay. So let's turn now to the functions of banks in a little more practical sense. We've already talked about that financial markets in general perform several tasks. First of all, they help coordination. Financial markets help to match lenders with borrowers and provide them with an opportunity to trade. This is very true even with retail banks. If you have too much money on your bank account, you do not want to look for some investment projects. You simply want to bring it to a bank, earn a small interest rate, be safe and have security and safety when it comes to your deposits, and the bank will then choose investment projects for you if we have interest rates. Allocation. It's about efficient allocation. Why? Capital is a scarce good, meaning that there's always, well, usually if these were normal times with positive interest rates, capital would be a scarce resource. But if it is, someone needs to make a decision. Who offers a good investment project? Who does not offer a good investment project? And banks will screen and monitor investment projects in also retail loans, also mortgage loans, and then they will select those projects they will invest into, and they will efficiently allocate the scarce resource capital. That's the theory. In the European Union right now, I guess banks will give credit to and loans to anyone or not, and firms do not want to invest, but that's a different story. Selection of market participants. In some cases, access to finance should be limited. You can view this from both angles. Access to finance is very important for households, for customers, but also to firms. But sometimes access should be limited, because if you're a bad lender, if you're a bad borrower, if you always default on your loans, you should not get a new loan. And there should be sanctions, and market participants, someone should screen you and make sure that you don't have access to financial markets. So selection by credit risk, qualification, etc. That could be a function. Now, in addition to these, we've already spoken about lot size transformation and maturity transformation. Banks easily transform maturities. It also creates their greatest problem, maturity mismatch, long-term investments and short-term financing, and different sizes and lot sizes are transformed, small deposit contracts, large loan contracts, big business or mortgage loans. Risk transformation is also one function. Risk is transformed. We want safety for our deposits. Mortgage loans, retail loans, firm loans are riskier, so risk needs to be transformed. In addition to these abstract services, we've already seen that banks also fulfill certain important functions in an economy. First of all, it supports the supply and creation of money. If you take a class on financial intermediation or money theory, you will probably learn that at least under certain assumptions and in some theories, banks help create money. Now this is somewhat controversial among economists, and I don't want to enter that discussion. Ask Professor of Economics to discuss this more if this interests you. But usually under certain assumptions you can assume that banks via lending and with reserve requirements being less than one, banks create money and enlarge the supply of credit and money. They provide liquidity by investment services, and they are responsible for payment services and money transfers. That's very important in an economy. Very practical function. Some elementary functions are conversion, deposition, transport, and financing. And we have transforming functions like lot size, maturity, and risk transformation. This can be very trivial. Just think of making sure that you have cash on your hand, making sure that ATMs are stocked. These are very practical reasons and very practical functions, but nevertheless, of course, very important for banks. Additionally, banks engage in deposit business, credit business, discount business, trading business. We've seen all those functions when we spoke about the legal definition of a bank in the German system, and I think they should be quite clear. Safe custody, investment banking, loan acquisition business, and so on. Well, I can skip this. We already know what a bank is. What is more important? What is the main function of banks in macroeconomics and economic policy? What is the most important function when it comes to economics? Why do economists and financial economists care about banks? What is the European Central Bank trying to achieve via the zero interest rate policy? Lending. Economists more or less only care about banks for two reasons. First of all, they might endanger financial stability. That's a byproduct. And the function banks fulfill in an economy, from an economist's view, is they give out loans to households, but more importantly to firms. So in macroeconomics, for example, in dynamic stochastic general equilibrium models, in DSGE models, you will always see a banking sector that accepts deposits from households and that channels deposits to the banking sector, to the firm sector, to the industrial sector, for firms to take on loans and to invest and create jobs, pay out higher wages, and so on. And for the benefit of banks supporting economic growth via lending, this is the only reason why we would accept financial stability concerns in such a macroeconomic model. So think about this. Banks, via lending, help firms to invest, create new jobs, and enlarge economic growth. This is the only reason. It's always about lending. And this is what currently does not work in the European Union. The European Central Bank is piling up money at private banks and forcing banks to pay an interest rate on any deposit with the European Central Bank, because it wants to force banks to give out more loans to firms. in the idea that if banks give out cheap loans, firms will get cheap financing and they will invest more, which they are not doing. What is the simple reason, or might be the simple reason, why they are not giving out loans? The assumption is, going back to your basic finance introduction, that if you are given a set of 10 investment projects, you would rank those according to what? Their net present value or their internal rate of return. And a company in this very basic, stylized model would do yes, 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 no, 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 no. Now, if interest rates, if the risk-free rate is here, then we know we would do this project, yes, yes, no, no, no. Then we would just keep our money at the bank. Now, the idea is, of course, right, that if we lower interest rates to 0%, then we should do this project, and this project. But only to a certain extent. A firm will never engage in a project that offers a negative net present value or negative internal rate of return, very simply. So this is what's happening right now. Assumably, that if this is the case and these assumptions hold, then why should firms invest more? They should not take money from the European Central Bank and invest in negative NPV projects. You will find this in research articles all of the time. Negative NPV projects, net present value, Nettokapitalwert. Negativer Kapitalwert ist ja nicht vorteilhaft. Now, on a side note, has anyone learned about this before? There are some cases where firms will engage in negative net present value projects. Any idea when? It's a very, very delicate argument and very sophisticated argument, actually. Assume this is your default barrier. Here, you're bankrupt. This is default. And assume this is your company. If you're here, right close to the default barrier, you can easily show, and if you've taken my financial risk management class yet, you know what I'm talking about. You can easily show that the firm value and the value of equity equals a put option on firm value. It's equal to an option contract. And this option contract at this point is right at the money. And at the money, at this point, the value of the option contract is heavily influenced by volatility. Meaning that, to make it short, and to make it understandable for those of you who haven't learned about options and option pricing, this is the point where managers and shareholders gamble for resurrection. If your company is close to bankrupt, what is it worth? For shareholders, 0. It's close to bankruptcy. So what will you do? Will you simply let your company slide away silently? Or do you think, well, if I'm going out big time. And managers and shareholders will drive up risk, increase volatility, because they cannot lose anything. The company is already bankrupt. It's close to bankruptcy and it's almost worthless. And this is what we call gambling for resurrection. You might know this from hockey. If you're down by 1 goal and you only have 20 seconds left, what do teams do in hockey? Isn't anyone from Canada? Yeah. What do hockey teams do in that scenario? You're down by 1 goal, only 20 seconds left, and you're on the move. What do? You pull the goalie. You gamble for resurrection. You take out the goalkeeper, and then you have 6 players on the ice, and you can attack with 6 against 5. Right? 6 against 5. Yeah. That's gambling for resurrection. Same in soccer, football. If you're very desperate, you take out the goalkeeper because you think we either equalize or we will lose with 1 more goal. We don't care. Same here. Gambling for resurrection. And in that scenario, you are no longer taking just positive NPV projects, but you're taking even those with a negative NPV that offer high volatility. Because it might simply be that you drive up profits and you increase firm value. Very, very elegant argument by Merton. Okay. Financial services are also offered by banks. We can go through these. I guess this is not too interesting. We've already talked about this in the context of the legal definition of a bank. Investment brokering, investment advice, operation of a multilateral trading platform, placement business, contract brokering, etc. All these things are obviously services that will also qualify you as a bank under German law. Non-EEA deposit broking, foreign currency dealing, factoring, financial leasing, asset management, proprietary trading, portfolio management. All these services can be offered by banks. Does anyone know what proprietary trading is? It's trading against your own inventory and on your own account. You're not trading for someone else, but you're trading on your own, for your own profits and losses. If you're interested in this, we'll talk about this later on. In the US, this is closely related to the so-called Volcker Rule. Paul Volcker is a former chairman of the Federal Reserve Board, and he proposed, as part of the Dodd-Frank Act, the implementation of the Volcker Rule, which means that if banks, I hope I can give you the idea correctly, it states that if you are a bank in the US and you want to engage in proprietary trading, you need to fulfill higher capital requirements, because proprietary trading is highly risky, and this is a rule that tries to limit risk stemming from proprietary trading. Deposits, well, we always have talked about deposits here. Placement of deposits by micro-investors plays an important role for the economy of any country. Deposits are the main part of a country's money supply. It's always true. We are always concerned about deposits. It's mostly a question of customer protection and consumer protection. Increase in deposit leads to an increase in the amount of money circulating in an economy. And if all other factors are equal, money supply will rise. That's the theory behind it. We know deposits. We'll here look at a very simple example of a credit multiplier. You might know this from an economics class. The credit multiplier is a very simple, basic, also controversial model to show that in this toy model setting, overall money supply is increased by a bank. What do? We have the assumption that modern banks retain only a portion of the money they receive from deposits. So you get $100 in deposits, but you only keep like 10% as a reserve. And these are minimum reserve requirements. Almost all countries and central banks have them in place, minimum reserve requirements. So you need to keep a certain amount of deposits as a reserve. Bank remains liquid in the case of cash withdrawals, and they have at least some of the reserves. And the remaining part will be offered as loans. And the assumption is, first of all, there's only one bank. Required reserve rate is 10%. So what happens is, we have liabilities, deposits, 50. We need to keep 10%, so 5 as a reserve. And we give out 45 as a loan. Now, we increase deposits by 50,000. So we have deposits of 50.05. We again have to keep 10% as reserve, so it's 505. And then we have given out only 45 as a loan. So our minimum reserve ratio is 10.1%. So we adjust it, we give out more loans. So we get 45.045 as a loan. Again, we have fulfilled our minimum reserve requirement of 10%. This is not so interesting so far. It only tells you that you have to keep 10% on your balance sheet as a reserve, and you give out 45 as a loan. No big problem. Now let's assume the bank holds, oh, this is actually just the verbal description of this. We give out additional loans of 45,000 euros or pounds. Again, the credit multiplier here, in this case, the change in the deposits divided by the change in the reserve is 10. So it's always the reciprocal of the required reserve rate of 10%. Now let's look at this extension where we now have more banks. There is more than only one bank. A experiences an increase of deposits, 50,000 euros or pounds, retains 10%. Remaining 45,000 euros can be granted as loans and will eventually return to the banks. And money is lent to an individual who reinvests it at Bank B. Bank again retains 10% in cash and invests the rest, for example, into lending, and then it goes on to C. So what happens is every step leads to a 90% growth compared to the original situation. If we sum this up, we have 50. We can then give out 50 times 90%. The next bank can give out 50 times 90% squared, and so on. And this geometric series converges to 50 divided by 1 minus 90%. And this is 500. So for this case here, the deposit multiplier is equal to the reciprocal of the required reserve. So 50,000 euros leads to additional 500,000 euros in the system. Very basic scenario. If Bank A gives the money to Bank B and to C and so on, and if we include enough banks, the maximum is 500,000 because each bank only has to keep 10% of the initial money on its balance sheet as a reserve. That's a credit multiplier. Disadvantage of the model is very simple, not very realistic. System has weaknesses, for example, that money can go overseas, usually not possible, and individuals invest their capital in government bonds or keep it as cash rather than depositing every last dime for the bank. Nevertheless, the idea is, obviously it will not be 500s, but the initial amount of deposits increases because of the credit multiplier. And this is sometimes considered to be one of the many reasons why we have banking regulation and bank supervision, because we need to make sure that by checking the minimum reserve requirements, we can A, control the amount of money that is created in the banking sector, but we can also B, make sure that banks are checked, that banks have a certain minimum amount of reserves on their balance sheet in case people want their deposits back. Because this is like a card house that could fall down in case everyone at all these banks immediately runs to your bank, to his or her bank, and demands repayment of the deposits. So this is one explanation and one reason why we need banking supervision and regulation. Yes. Financial services, again, I think the headings got mixed up a little bit. This is a slide and a graph from the textbook by Cassou, Giraldone, and Molyneux. Financial intermediaries, deposit-taking institutions, non-deposit-taking institutions. Again, you see we have banks and building societies. On the other hand, we have insurance companies, pension funds, investment funds, and they usually cater to large institutional investors. But it's a classification. Deposits can be withdrawn arbitrarily, determined freely by the lender. I think this is not very interesting. Again, make sure that you know that in the European Union, banks are allowed to offer a full range of services. Same in the UK with the Financial Services and Market Act. We will see, I guess, a lot of things to change when and if the UK finally gets Brexit done, because I think this is one of their main unique selling propositions they have left, apart maybe from British beef, to liberalize and deregulate the financial sector even more. If you take away the London city, I guess you don't have too much left. So this is where they will try to make Brexit great again. Here, in 2000, banks in Great Britain were allowed to operate in taking deposits, issuing electronic money, implementation of insurance contract, investments, management of investments, and instruction and advice on investments. Pretty similar to what we have in Germany, but with much less supervision and regulation. There is, in general, across the whole world, a huge trend to consolidate, to form even bigger and larger banks. Why? It's just a question of economies of scale. You don't need 20 production plants for a bank. You need one headquarter, maybe one or two large centers and branches. And especially in investment banking, you don't, there is no need to have 5 large headquarters. So if you merge, you can use economies of scale to reduce costs dramatically. And for many reasons, we have seen consolidation in banking, the number of banks going down, and I'm pretty sure that the current zero interest environment will lead to even more bank mergers and bank close downs, especially in Germany. My bank has already merged. There used to be 3 local banks owned by 3 cities in one county, and it has now become just one single bank for the whole county. Makes sense. Yes. And we have a second bank directive in the European Union. This allowed banks to work as universal banks, and they can offer any product, any financial product they want. Banking services, payment services, that's also very clear. Deposits and loans, investments, online banking. You can go through these. This is, I think, quite clear. Online banking, I included this when I first offered this class 4 years ago. I guess in a couple of years I will probably have to remove this from the slides. Because nowadays I think everyone does online banking. I guess at some point will become the mainstay of banking and of banks. The question is, which banks will have survived to this point? If it's just Apple, if it's just Google, if it's some kind of Bitcoin or cryptocurrency wallet, or if it's a traditional bank in our today's sense. The reason why I guess one does not have to discuss the reasons why online banking is so present everywhere. The problem is, I think, and this is quite interesting to discuss, why it took online banking almost 15, 20 years to succeed in the way it does now. Because, I mean, I started to do online banking 18 years ago. I mean, banks offered simple payment services almost 18 years ago. I think it's the introduction of the smartphone that helped online banking to be the first choice of service when it comes to payment services and payments transactions. And the benefits are quite clear. Simple cost reductions. It's interesting in the context of German banks. there are some banks who don't have pretty good online banking, and for example, the local banks, they have the same system and they have the same website for all local savings and loan associations. They have only slight variation from bank to bank, but basically they have the same system, and they are now desperately trying to include customer points of sale and points of contact with their branches and their customer representatives and their customer agents. What they do is, actually I should show you this, every time I enter my online banking portal, I'm shown a picture of my customer client. And I thought that, oh look, they're trying to be innovative. Yeah? They want me to think, this is my personal customer client. Problem is that at the start, it switched every couple of months. And I did not even know the guy. Yeah, then I had a female client agent, then it went back again to the one I have now. And every time I want to do something, I told you this example, even when I walk to the head branch, every time I want to do something, they desperately try to force me into a sales talk. You have to make an appointment. You have to come to Mr. Yada Yada and talk to him, and even with the small transactions I sometimes have to do, they want to lure me into a conversation with my sales agent. Even worse is they now offer video calls, and you can now get an appointment with their special online video task force. Three people below, I guess, the age of 25 who sit in front of a computer all day and try to convince people via video to buy some securities, because that's basically what the only thing they're earning a commission from. Yeah. So it differs from bank to bank. Some are actually very innovative. Some still operate web portals dating back to 2005, I guess. And now all these banks in Germany have some problem, because ideally they would not do online banking at all, because that's not how they sell business. They would like to get people come to the branch and to engage customers in a sales pitch, in a sales talk, but that's not how it works nowadays. Okay, so online banking, you probably know the basic problems associated with online banking. Security, safety. What is interesting, I'm not so sure if I have it on the slides. Might be. You can read through these. Option for banks, forex trading platforms, advantages, and so on. Is online banking profitable? Well, I don't think it's really profitable. It's just a must-have service banks have to offer. But let's make it a little bit more practical. Does anyone know what PSD2 stands for? PSD2. Ever heard of that? Anyone? It's the European Union's Payment Services Directive 2. It's meant to be a game changer, and I think it will be. I think it came into effect 2018, January. What is the PSD2? Before that, banks were not forced and were not required to disclose information on their customers. But now, PSD2 states, and it forces financial institutions, that if I am the customer of my bank, say I'm with Deutsche Bank, I'm a customer at Deutsche Bank. If I if I tell, for example, the perfume store right across the street, here is my written consent that you can access all my data at Deutsche Bank, the perfume store can take this written consent, show it to Deutsche Bank, and Deutsche Bank is forced to disclose, to relay the information on my account, and they need to make sure that they have proper technical IT interfaces in place to transport the data to the customer, in this case the company that is requesting the data on behalf of the customer. Why is this so important? It is meant to support the growth of fintech companies in the European Union. Because even if you're a very small company, if you offer some kind of service, and there are some fintech companies who are trying out strange things. I could come up, I think this has been done. I'm a fintech now. I call myself a fintech. I offer now life guidance services. I want to guide you. I want to tell you how you can improve your life. How do I do it? I need the information on the transactions on your checkings account. You tell me that you're a customer with Commerzbank, Deutsche Bank. You give me your written consent, and on an internet website, you simply have to click one button, and then I will go to your bank, I will retrieve the information, and I will use machine learning and artificial intelligence algorithms to tell you you're spending way too much money on wine. You're spending way too much, actually this would probably happen to me, I'm eating way too often at Vapiano. Yeah, I'm eating the same salad too often at the same restaurant. Strange example, but this is what fintech companies are now doing. They are analyzing big data from your financial accounts to tell you how to maximize maybe profits, how to save on your insurance contracts, and so on. And this is only possible because the PSD2 now forces banks and financial institutions to disclose this information because you are the customer, it's your data. If you want it to be transferred to someone else, then banks have to comply. This is the PSD2, and it's meant to support the growth of fintechs in the European Union. I might have told you this, that I actually was quite surprised that in Japan, I just heard that starting October 1st, the Japanese government has, I'm not quite sure how they've done it, at least companies are now offering a 5% discount on all cashless payments. And I guess all countries are nowadays trying to facilitate cashless payments, new ways of financing. They are desperately fighting against cryptocurrencies because this is where governments feel they are attacked by companies like Facebook, but they're fighting cryptocurrencies because they want to keep their own currency and a single currency, but every country is trying to support fintechs, new forms of financial intermediation, and reducing the costs of financial intermediation. And this is, I guess, one thing that builds on online banking, but is much more relevant and current than traditional online banking. This is, I think, a little bit outdated. Okay. Do you have any questions concerning the services offered by banks, online banking, PSD2, etc.? Because if you don't have any further questions, because it's late and I'm pretty sure we are already the graveyard shift here at the faculty, I would say we stop here. Next will be central banking. We cannot talk about banks without having talked just a little bit about what central banks do. They are the ones who supply banks with initial capital and who also many times supervise banks, just like Deutsche Bank and European Central Banks do. European Central Bank does, and Deutsche Bank and ECB do. We'll talk about central banking, what central banks do, how usually they are built, what functions they take over, and how they interact with private banks. And then we'll continue. So if you don't have any questions, thank you for your attention and have a nice evening. Thank you.